Good morning, ladies and gentlemen. Welcome to BTB's Financial Wellness Training in partnership with Zurich Consulting. Thank you so much for being here for this entire month. And so today we'd like to welcome you to our last module. And as you may know, due to popular demand, we change it to investment. So karibuni sana, welcome to the fourth and final session of the personal financial management training. We began, yes, thank you. Hi, Denise. Please say hi in the chat. As always, let us know where you're joining us from. As always, what you've picked so far, your key takeaways, and what you're looking forward to in this session. So karibuni sana. We had our first module on understanding your financial position, the second on the key pillars of financial security. And last week, we covered creating a practical budget. And today, due to your engagement and feedback, we decided to change the direction a little bit to cover investments, because a lot of you requested for this module and were very keen. So this week, we are covering investments. So karibuni sana, let us know what you're looking forward to in this session. If there's any changes you've made in your personal finances so far, we would be so keen to hear and to understand. So thank you so much for your commitment the entire month of May, for taking the time and dedicating your time to learning how you can, take better control of your finances. So we really appreciate. And as mentioned, today we'll be covering investments. We'll continue with Elizabeth. As you have learned by now, she's a seasoned professional in the investment space, in the financial literacy space, and she'll be taking us through the module. But we also will have our head of custodial business, Mahmoud, who will be taking us through other insights when it comes to investments and even how DTB can support. So we have a good day packed for you with lots of lessons and insights you can get. So thank you so much for joining in. We see Watamu in the house, Kilifi, Nairobi, all of that. And David says he hopes to recover his days eaten by Nzige. We agree. Yes. Keep sharing what you're looking forward to. Keep sharing what has changed for you since we began in the month of May. At least on 31st of May, you can say something has shifted for you due to these sessions. So thank you so much. I will welcome Elizabeth. Then after the break, we will have Mahmoud joining us, and I will introduce him at that point. So I'll also give instructions on the sign language interpretation on the chat. But karibu sana, Elizabeth.
Thank you so much, Mantui. This has been great. I think it has been a really good journey. We ended up at telling our money where it goes. So today we want to take the where the money goes, because we want to understand what are my investment options. So please, I'll try move fast. If I'm too fast, you stop me. But I'll just make sure that we move very fast so that we can cover as much as possible. Yeah. So today is really about smart investing. We need to tell our money where to go. And as usual, I want us to start here. If I handed you Kenya shillings 1 million today, what would you do with it? Take a moment to think about it. And let's put it in the chat. What would you do with that 1 million shilling if you got that today? And remember, we have told where our money needs to go. What would you do? Caplot. Thanks, Alex. You would buy a caplot there, buy a car. Ooh, Gilbert. Hope a car is for bringing money, open a business. Hope you have the pillars of the business. Thank you so much, Duncan. I would buy land, invest in a circle, invest in money market fund, invest in real estate. I would refurb and improve my business. IFB. Thank you very much. Okay. Plot, MMF, pay off my debt. Great. I think, Mantif, just from the responses that we have today, we can actually say that at least we have done some little bit of work so far in terms of just knowing where to take our money. So the second question comes in. If you lost your money today, but kept your knowledge, what investment should you start with? Assuming that you're starting from zero, where would you start? Yeah, you've just gotten a new job. You didn't have anything that you had invested before. Where would you start? Eunice is saying money market, invest in a business. Thank you so much. That's the first thing that you do, invest in a business. MMF, great. Most of us would start with my MMF and SACCO. I would start by paying off my debt. Let's assume that you're, okay, thank you. Invest in real estate, join a SACCO. Great. I think these are all good questions. Then what's the one thing that has stopped you from investing more confidently? So that we can see whether we'll touch on it today. What is the one thing that has actually made you not invest confidently? Is it the lack of knowledge? Is it fear of losing your money? Is it not enough capital? Trust, inflation, not sure where to start, cost of living, fear of losing cash. So I'm seeing a D, not sure where to start. At A and B, lack of knowledge. So the beauty is, now that we have been here for the last 4 sessions, I think the first one, A, we might not be at A, but at least we're at 50%. So most of us will leave here and say, okay, fine. Not only do I know where I can get the knowledge, I have the knowledge, and if I don't, I know where to get the knowledge. So this is really great. Fear of losing my money. Okay, we shall hope that by the end by the time of this end of this session, we shall know how we reduce that fear. So I want us to start with Mary here. So Mary earns 150,000. She's a HR manager. She has savings of 350 sitting in her savings account. You remember savings, not investing. Wants to grow her money, but isn't sure what's best property, stocks, or money market to start. So that is what we have said, most of us here. So Mary has been saving diligently, but every time she considers investing, she hears conflicting advice. Buy land, invest in stocks, join a SACCO, buy a money market fund. She's afraid of losing money or being conned. That's exactly what we have been told, most of us have said. She doesn't know how to evaluate if an investment suits her. And then she wants her money to work harder, but also she wants flexibility in case she needs it. So you remember the 3 things that we said. I need to know the return, the risk, and the liquidity of my money. So those are some of the things that Mary is going through. Then Mary's turning point. Mary attends a financial training session like this one, where she learns, clarify your goals. She wants to buy a home in 5 years and would also like to have access to an emergency fund. So she segments her money so that she has some in money market fund, another one in more risky balanced fund. And then she has started saving for her real estate project because she wants to have a home in 5 years. So for 350 might not be able to buy the property, but she's starting today. So the another thing she does is do her due diligence. She checks the licensing of the fund managers, compares returns across fund managers, and then starts now. So later in 6 months, she has grown her savings slightly from the MMF, feels more confident as she tracks performance monthly. Remember, when you invest in a money market fund, you're actually getting a fact sheet every month. So you're understanding a lot of what is happening in the market. And then now she's reading a lot about property investing and planning her next move. So that's why most of us are here. So who here relates to Mary's situations? Who do you have done differently? I want again to go to the chat. Is there anything that you would have done differently if you're Mary? So how she's split her money, 350,000. She's put some in a money market fund. She's put some in a balanced fund. And she has actually now started investing. So I'm like Mary. Thank you, Duncan. I don't know any of us. It's only Duncan who relates with Mary. Who else would advise Mary to think about before choosing an investment? What would you tell her? Is there anything there that you'd tell her other than as she decides on all these investments? What would she be looking at? Anyone? Again, it's things that you have captured. What are your goals? So these are the things that we are going to go through. How do you decide where to invest? And these are really practical examples of people that we work with on a day-to-day basis. So today we are jumping just into investments, saying that the investments are in capital markets. So we will not be able to capture things about running a business, maybe real estate. That we shall do much later, at a later date. So traditional investments, these are really investments that are easy to get into and to get out of them. They include things like fixed deposits and treasury bonds and bills. Then we have the stock market. We shall again be looking lightly at those deeply. So we shall cover fixed deposit and treasury bills and bonds, and then equities for this session. Then there are what are called alternative investments. These alternative investments are actually, you just can't walk in and get out immediately. They have some lot of structuring around them. So if it's real estate, You can just go and buy an apartment, but you have to do a little bit more of work to know which is the right location, what is the yield that you're going to get, and how will you get out. The things about unit trust and mutual funds, again, also comes in because we have to think about who are we investing with, what kind of underlying assets do I care for, then things about money market funds, SACCOs and chamas, then digital investments like the cryptos. So those are alternative investments which we shall only cover the money market funds or the unit trusts today. So the first question is, how, if all this, I have all these investments that I can put my money into, how do I decide where to invest? The number one starting point is investment goals. Where am I investing? And maybe you can just put in the chat, what are some of the goals that we invest for? Why am I investing today? Yeah. Why am I putting this money aside? Or why am I even earning? You know, you must have a goal. What are some of the short-term goals that we have? To grow wealth to the long term. Thank you so much. Financial freedom. Thank you so much. And you remember what we said financial freedom is ability to do what I want to do with whoever I want to do with money not being a significant determinant. So for emergency, yes. So financial freedom for emergency, for secure my future, which is again knowing when to do what I want to do, retirement freedom, ability to have choices. So all these are our goals. But this is the long-term goal. What are some of the short-term goals that we invest for? What are some of the short-term goals we invest for? To be financially stable in the long term. So what are some of the short-term goals that we invest for? Things like maybe emergency, which we said now you have to have at least 6 to 18 months, 6 to 12 months of your living expenses in a near liquid investment. So education is one of them. Yeah, for emergency, to travel. Yes, thank you so much, Susan. Meet daily expenses, education. Yeah, those are some of the goals. So you need to know that if this is the goal I'm investing for, then this is the kind of investment I need to go for. Let me give you an example. You cannot take your kids' education school fees for next term and put it in real estate, because when that time comes, it might not be able to, you might in a plot, you might not be able to exit that plot and sell it. So those are some of the things that you need to look out for. The other key question is about risk appetite. We are all being cultured differently. We approach life very differently. So it's good to understand our risk appetite based on where we are going, but also based on what you want to invest and sleep at night. So that is very important for us to do a risk appetite. There's even tools that can help you understand what kind of risk appetite that you can take. The other question is about liquidity needs. Remember, yes, you can actually be getting really good returns, but the question is, how does that money get back to your pocket? That is very important. And as we go through the various asset classes, we shall be covering how the liquidity of that particular asset class looks like. The other key thing is diversification. You cannot put all your eggs in one plate. We must make sure that at least we diversify. And it's actually said the investor who does not diversify is the one who believes they are correct all the time. Because remember, investment is a game of probability. The probability that Safaricom will come from the current price to go to a different price is a game of probability. And we shall see how we determine that probability. Then the other key question is about investment horizon, because I need to know, am I investing for the 20 years, or is it for school fees in the next 3 months? Because that determines where I'm going. And then finally, ask question, do your due diligence. Who am I investing with? How are these people making money? How is that money getting transferred to me? So as we do all these things, remember at the end of the day, you are giving out your money. And one of the questions that we said we do not want one of the challenges of investing is that I don't want to lose my money. So the question is, how do you do the due diligence to make sure that you're getting the right investment? Great. So I want us to go now to the fixed income investments and understand what are my options. So some of the ones that we have is bank deposits. These are relatively very secure. It's what you would call to you'll call DTB, and they'll be able to give you a deposit. We shall look at the two types. We have treasury bills. Again, we shall look at what are treasury bills. Really, they're short-term investment. You're loaning money to the government. And I'm sure all of us have seen a lot of conversations about how much the government have borrowed in the domestic market. So they come to the domestic market to actually borrow by offering treasury bills and treasury bonds. Treasury bills are short-term. They are 91 days, that is 3 months, 182 days, those are 6 months, and 1 year, 364 days. So you get your money, give them government money, and then they will pay you back. Then we have government bonds, and again, they come in different ways and tenors and different returns. Again, we shall get into details on that. Then the other one is commercial paper and corporate bonds. You can actually decide that you can you lend to to an institution. So an institution, let's say, for example, and I'll just use DTB, for example, they want to grow their capital base. They come and actually ask for money from the market. That is, they can come in the form of a commercial paper, which again is really short term, 91 days, 182 days, and 364, or corporate bonds, which are much longer term. We have seen things like EABL come there. Then we have structured solutions. I'm sure most of us have heard of a couple of structured solutions that are given in the market, special funds and all that. These are really structured to mimic the underlying assets, whether it's a fixed, whether it's a real estate or whether it is a business that is being offered. So those are structured solutions. And these ones, you need to ask more questions. You need to understand them better as you give them your money there. So let's jump into, you go walk into the bank. You have an investment that you have a transaction that is just about to close, or you're buying a land transaction. So you have some cash in your bank account. You can actually speak to your relationship manager. If you are sure when the money is going to be required, then you can place it on a fixed deposit. Or if you're not sure when this money is going to be required, then you can put it on a call deposit. What are the advantages of each? When you look at a fixed deposit, you actually know your interest rates enough upfront, and you already know how long it's going to when you require that money. The thing is, if you go, you place your deposit for 6 months, and then 3 months you come and you want your money. Remember, as the bank has already placed that money with someone else, they are issued a loan, they will actually penalize you. So you might not get your full return that you had already you have been given. That is the advantages of fixed deposit. You get a higher return, but be sure about when you require the money, because then you could actually lose some bit of that return. Call deposits, the rates actually fluctuate depending on the market returns and the liquidity in the market. So here you walk in anytime, you just tell them, I need my money tomorrow, they'll give you that money, and the liquidity is very high. So when you're choosing between a fixed deposit and a call deposit, understand the transaction on the other side, the goal that you're investing for. Is it something that you're certain? If you're not certain, put it in a call deposit, the returns will be lower, but also the penalty will be much lower. So that is really about bank when it comes to banks. So for you, it's just to decide which bank am I going to place the money with, how returns are they giving me, and what kind of, you can actually do some analysis on them. Most of the sophisticated investors will do significant analysis on the banks. But as an investor who is maybe a retail investor, I would recommend that you just go to the bank that you usually deal with on an ongoing basis. Then we have the treasury bills and bonds. This one is, we are lending money to the government. We lend money, I said, through treasury bills and treasury bonds. So that for treasury bills, it's 91 day, 182 day, and 364 days. How it is usually done is the auctions are done every week. So every week the government is coming to the market and saying, okay, I need money. Can you, I need money, and this is what I'm going to use this money for. I'm going to redeem some of the money, some of the loans that are maturing, and I'm going to borrow more on this. So that is done on a weekly basis. The way the pricing is done is it's at a discount. So if, for example, I'm investing 100,000 at 10% for 1 year, instead of paying 100,000, I'll pay 90,000. But on maturity, I will get 90,000. So that is how the treasury bills operate. Here, the interest rates, whatever you have locked in today, you already know this is what I'm going to get for the next 3 months. It's going to accrue, and I'm going to be paid on maturity. So the only challenge is, when you have invested in a treasury bill, you have to wait until maturity. So if it's a 91 day, I have to wait until 91 day. If I must get that money back, I can go to CBK, and they are going to discount it for me. And most probably you could actually lose some money if you did that. The other key thing is that the tax on treasury bills, it's 15% withholding tax for individual investors. So those are some of the things that you need to know. For government securities, they are of 3 types. One is zero coupon bonds, which again operate largely by treasury bills. They are relatively short term. Lately, the government has not been issuing zero coupon bonds, but the tenor is usually like a maximum of 2 years. So what happens is that you have to wait until maturity for that as well. And they operate largely like what I have explained for treasury bills. You're investing 100,000. So what happens is, if it's a 10% and it's a 2-year bond, for simplicity's sake, I will just pay maybe 80,000 for 100,000, and then I will get maturity of 100. Then we have infrastructure bonds. Infrastructure, let me first go to fixed coupon bonds. Fixed coupon bonds, again, issued almost every month. Lately, the government is coming in more than once. So what they do is that they will tell you, I'm offering this 10-year bond, and they will ask you to determine what is the rate that you're buying it at. So if, for example, it's a 10-year bond, they would issue it at, they would come and say, this is the coupon. So the coupon is every 6 months, you're getting some return. So you accrued interest every 6 months, you're getting that. It's called a coupon. So that coupon comes to you on every 6 months. But now that coupon is not necessarily the yield that you're getting. It's not the return that you're going to get. So at that particular point, you could actually be paying higher than for every 100 shillings, you could pay higher. It say that you're paying at a premium, or you could pay lower, depending on the interest rates environment. So let me give you an example. Late last year, maybe a 10-year bond was being issued, and a treasury bond was being issued at a 15% discount, at 15% coupon. If the interest rates have come down to 14%, it means that now you are holding a more valuable bond. So the amount of the value that you'll be holding is higher. So if you were to sell that, or the government was to come for the same on that, then you'd be buying it at a premium. The opposite is also true. If, for example, you are holding a bond that is 15%, interest rates go higher. It means that what you are currently holding is actually less valuable. So people will pay you less for that particular instrument. So all in fixed income, when you think about the analysis and everything, it is basically what we learned in compound interest when you were in school. Something that you're just looking at the present value of all the future cash flow. What is the value today? So that is a fixed coupon bond. For infrastructure bond, again, work very similar to a fixed coupon bond. The only difference is for this particular one, the government is telling you this is going towards infrastructure, road A, dam B. That is what happens. Then now what they do is, to make it more attractive, it is tax exempt. So you don't pay tax on the infrastructure bond, and they are various. So again, to summarize, you are lending to the government. For you to lend to the government, you can do it through treasury bills, treasury bonds. Treasury bonds, they come in as fixed coupon, infrastructure, or zero coupon. You determine the yield. How are yields determined in the market? Because yes, I cannot say like, please, I'm going to buy this particular bond and I want 15%. You have to understand the market. What is going on in the market? Is the government very desperate to get money? So are they willing to pay higher? Or are people having a lot of money to go towards that? So the beauty about government securities, you know the cash flow. You know when you're going to get what amount of money. The other good thing about it, if you're buying that bond, you can actually trade it. The day you need that money, you can go to the Nairobi Securities Exchange and you trade it. But here is the catch. For your 100,000, for your 1 million, if you went to the market to trade, you are a price taker. So people will buy it in form of an odd lot, and you could end up losing money. So we need to be careful about that. So what do I need to know? For me to buy into a government securities, there's a process. I just can't wake up and say, now I want to buy into, I want to get into a government security. I need to open what is called a CDS account. And the CDS account you can actually do it now through DAO, which is online. Everything you can actually do it online. Or alternatively, and that is one of the things that Mohammed will be taking us through, you could actually do it on a tertiary basis, whereby you go to DTB custody, they bid it for you on your behalf. Or alternatively, DTB themselves, they actually buy and then give it to you. So those are different ways. But now, direct investments, you open a CDS account, then you have to look at all the required documentation. They are not really a lot. You must have a bank account, because the payments will be done to your bank account. That is your coupon payment, and your payments for that bond, it will actually be done from they'll debit your account. Then you decide what investment to invest, then fill an application form, you submit your bid, you get your auction results, and then you must pay. So remember, once you bid, you must pay. Otherwise, you're blacklisted for 6 months. So it is very important that when I'm bidding, I want to put in 1 million shillings. I know that the money is in the bank account and I'm going to pay. That is very, very important. So for all of us, the practical question is, how do I do that? You just need to go download the DAO. Right now, they have made it very easy for us to invest, and you can actually look at the market. The treasury bill results are there on a weekly basis. So don't try to outsmart the market. You just bid closer to where the other T-bills were last month. The other good thing is, if you're investing up to a minimum up to a maximum of 20,000, you can actually invest what is called non-competitive. You're like, okay, I do not understand how interest rates are going to turn out, so give me whatever the market determines. So that is called a non-competitive bid, and most of the time you actually get successful on that. Yeah. So questions, why should I consider investing in government security? One, it's security. Government bonds are risk-free due to their low default rate. By the time the government is defaulting, all of us have defaulted. We have big challenges. So security is the most riskless asset that you can ever invest in. Then the other thing is about variety. You can actually get a bond in the secondary market if you want 1 year, if you want all the way to 25 years, you can actually be able to get that. You are so sure when the money is going to come. So your money is coming in every 6 months. It's clockwork. Every 6 months you get your coupon, and then relatively liquid because you can actively trade it. But again, as I say liquidity, remember what I said. What I said was, if you are going to be trading odd lots, there is a big challenge because you might not be able to get what the market is offering. So be very careful. And my recommendation is, if you're getting into government securities in a smaller way, not in the hundreds of millions, it is better for you to actually do it in an omnibus format, because that way you'll be able to get your return. Yeah. So that is government securities. I know I don't know whether I have lost anyone. Please continue asking questions so that I will be able to answer them as we move. So what?
Sorry, Elizabeth, just
Yes.
there's just one person who needed you to repeat the one for zero coupon bonds and fixed and the interest rate. Sorry for that interruption. Yeah.
Thank you. So I want to take let me go a step back. So the government comes to the market and says, I want to borrow from you. Within the next 2 years, I'm not going to pay you anything. So remember what we had talked about. Bonds, you get coupons every 6 months. So for a zero coupon, you will not get any cash flow coming to your account over that period of time. So it could be 1 year, it could be 2 years. Most of the time, because of the 364-day T-bill, it's now 2 years, but they have not been offering that. So the zero coupon bond, you don't get any cash flow coming in every 6 months. You wait until maturity. Yeah. So that is one. For the fixed coupon bond, it's, again, let me use an example of a 10-year bond that is offering 10%. So what happens is, every 6 months, you will actually get 5% into your bank account in form of a coupon. Every 6 months until maturity. The last maturity, you'll get your coupon of 5 plus 100 shillings for every 100 plus 100 shillings for every plus 100 for every 100 shillings invested. So that is the fixed coupon. You know your cash flow today, but that is not necessarily your interest. That is not effectively what the interest that you're going to get. So if, for example, we again go with the 10% 10-year bond, you could find that when you look at all the cash flows, someone will bid or will actually pay at a rate of 9% or even 12%. So that is the effective interest rate that you get. So cash flow is known, but the value or the price that you pay varies depending on the interest rates. And just so that you know, there is an inverse relationship between the interest rate and the price that you go to pay. So for every 100 shillings that you invest, there is a price. You might not necessarily invest 100 shillings for 100 shillings. You could actually be buying something worth 100 shillings, you pay 90 shillings, or something that you're buying that's 100 shillings, but you pay 110. So you're paying at a premium or you're paying at a discount, depending on the interest rate at any point in time. So I hope that, Susan, is clear. And infrastructure bonds will likely be like more fixed coupon bonds. The only thing different is where the money is used, one, and then number two, at times they amortize. What do I mean by amortize? After 5 years, they could start paying you some of your principal. So that is why they are slightly different they're slightly different. So if actually what we have done at Zurich, you can actually go to our website and you'll be able to see the various bonds and the various pricing. That way will help you actually determine, well, how do I determine what to invest in? Great. So I don't know if there's any other question. I know that is usually slightly confusing, but hope now it's clear. So what key factors should you consider before buying a treasury bill or bond beyond just interest rates? What is the one thing that I've talked about that you must consider as you buy treasury bills and bonds? Other than interest rates. I know all of us want returns, but what exactly determines which one to buy at any one time? just so that we know we are together. Any answer is right. Liquidity. Thank you. Thank you so much. Thank you so much. Liquidity, because when do I need this money? The investment goal. In most cases, let's always make sure that we are laddering our investments with the goal that we're investing for. Otherwise, we would get into challenge. So thank you so much for being very good students on that particular one. So I want to jump into the stock market. I want to buy shares. So what must I know, or what should I be aware of? Or who are the key players really in that particular segment? One, you're the investor. You need to know that all the investments are regulated by the Capital Markets Authority. Before anything is tradable, the authority has to give concurrence. So like, for example, when the Safaricom started trading, it came in through what is called an initial public offer. So that is how those things are done. Then you have the Nairobi Securities Exchange, which now provides the trading platform. So for them, they are again a listed company, and they actually provide a trading platform. It's like a Zoom now. It's like the company that provides the Zoom for trading. And then we have CDSC. These ones are holding your assets on the back end. Because remember, we no longer hold paper certificates. What we have are demutualized assets. You know that I have 100,000 shares, but they are held, your records are actually held by CDSC. Then we have the stockbrokers. You cannot actually trade directly. You have to go through a stockbroker. But now we have seen the stockbrokers really being able to automate such that you can be able to open and trade with them. And then for some of us, we want to invest through the fund managers. Fund managers are the ones who give you the advice and invest on your behalf. So they invest on your behalf, which is also very important. So how do I decide which stock to invest in? So understanding the stock market. So one of the starting point is I need to know which stocks to invest in, which stocks are available in the market. I don't know if you can just chat and say, which companies do you think trade in the Nairobi Securities Exchange? I would just like to see if we know some of the companies that trade in the Nairobi Stock Exchange. We have 62 companies that are listed. Which are some of them? DTB, thank you. Equity, Safaricom, KQ. Yeah, all those companies trade in the Securities Exchange. So you need to know, how do I determine which ones to invest in? And I will really go very fast in terms of that. So there are different categories of stocks in this particular market. The only ones that are tradable are the ordinary shares. So you really hold the last bit of it. Then how then do you go through the process? You have to open an account. And I say that you have to open an account through a stockbroker. There are very many stockbrokers in the market, some of them as automated and you can just do it online. And then you need to understand, what stock do I want to invest and what is the minimum quantity? So the minimum investment quantity is 100 shares. I think we are going through the process of actually being able to even to trade fractional shares. So all these trading volumes there, it's really becoming easy for us to interact with the stock market. So it's just good to know which which sector do I want to invest in. So how then do I determine which stock to invest in? I have 62. Which one? How do I determine how to invest? One is that I need to understand the fundamentals of the organization. I need to understand, how do these people make money? How is their management? How are their shares as available as I would want to? So you can only do that through fundamental analysis. And fundamental analysis is really understanding what is driving the returns of this organization. Let me give an example of Safaricom. Safaricom, how do they make money? They make money through data. They make money through M-Pesa. They make money through calls and all that. So you need to look at all this and say, how are they growing? When they went to open a branch in Ethiopia, how does that impact their business? So that one tells you, okay, fine, going forward, I think they are going to do well. Because remember, you're taking the final, when everybody else is paid, you as a shareholder, you're the one who is holding that. So you need to understand that. You need to understand from a fundamental perspective, what exactly am I buying into? How to do that is through analysis. So there are some companies that are high growth companies. Maybe I want to take more risk and I'm happy to get less dividends because I know the price appreciation is going to be high. So in that case, I will be buying what is more of a high growth company. So that is what I will be looking into. Then if the other ones will be high significant dividend stock, what I want is just cash flow. Which are some of the companies that have high cash flow, high dividend yields? So the question is then you need to understand which ones those are. A company like maybe BAT might not grow very fast, but their dividends is very consistent. Yeah. So the other way to maybe just decide what to invest in is to say, as long as a company is coming into the market through an initial public offer, I will jump into it. And that is how I'm going to buy into them. Some of them that some people bought into, if I can remember, was Kengen. Kengen did very well. When Safaricom came, yes, I think almost fully subscribed, but the share prices came down. So you cannot, that strategy might not necessarily be 100% okay. It is always good to understand what are the fundamentals of this organization. Then the other key thing that I'm seeing lately, especially for retail investors who are speculators, is just looking at the penny stocks. Things that are I'm paying less than 10 shillings, that if they increase in value by 1%, then it means that I'm going to get my return will be significant. So, and then the other ways people just decide where to invest is also the brands that we associate with. So for example, I'll buy DTB because I believe DTB is a good bank, and I know it's going to go, I'm a customer here. So those are some of the ways that people decide. But the key question is you need to make sure that you understand how are these people making money, how are they going to be impacted by the current economy, and how are they ready for any changes that are going to come in. So that is very, very important to understand how you make money. So there are three main ways in terms of, and I'll just say how you decide where to invest. I've talked about fundamental analysis. So you're looking at the cash flow of the business. I'm looking at the revenues. I'm looking at the expenses, because eventually I'm going to get the residual income. So that is called fundamental analysis. Then there is the technical analysis where I just look at trends. Let's say, for example, again, I go to Safaricom. It has traded in the last 12 months, it has gone all the way from 11 shillings all the way to maybe 40 shillings. So if it's trading at 20 shillings today, I would actually say maybe the probability of it going higher to 40 is higher. So I'll buy basing that it is going to go high. So just looking at technical analysis and the future, the trends previously. And then there is now what is called relative valuation. We have about 11 listed banks. So the question is, I like the banking sector. If I like the banking sector, which particular one do I want to buy? So remember, if you look at the price of DTB, of Family and Equity, and maybe HF, they're all very different. So you cannot just go and say, because this one is trading at 100 shillings, it is more expensive than the one that is trading at 10 shillings. So what then you need to do is create a way to compare apples for apples. And that way, what you do is look at some metrics like price to earnings ratio. For this price, for each earnings for each EPS, for each earning unit, how much am I paying? It's called a price to earnings ratio, because the value of the earning is the same. You know, a shilling that comes to my pocket is the same, but how much am I paying for it? Then the other thing is about the value of the book. So for example, the loan book less the net asset value, the balance sheet size. How much am I paying for it? So those are called things like relative valuation. And you should actually pay for the ones that are low. You should be able to pay little amount of money for each unit of earnings and each unit of the book. So that is relative valuation. This seems technical. However, all this information is readily available in the newspapers, and I will try to flash the newspapers in a minute so that we can actually be able to get how that information is. So I want us to pause and for a quick question. Looking at the 62 companies currently listed on the Nairobi Securities Exchange, which sectors would you invest in and why? Which sectors? I know we have written a lot of them here, but which sectors do you think are going to do well and why? Anyone? Again, remember, we are learning from each other. So I can see Roslyn said, I think her she's in the agricultural sector, Kakuzi, Williamson, and Limuru. I'll buy telecoms, thank you. Banking, telecom, insurance, technology, real estate, banking. Yes, I think we have most of them captured here. If you look at how the market is structured, we have the bulk of the investments really being in the banking sector. and then the telecommunication sector. So Safaricom has the total, if you look at the value of the entire market, Safaricom has about 35% of the market, and then the banking sector would have maybe 40%. So it is just good to know that in this current market, you'll always see that for you to be well invested, look at the banking sector, look at the telecommunication sector. There is a lot of potential in the manufacturing and agricultural sector, but again, a lot of work needs to be done. So thank you so much for that engagement. So we shall be taking questions at the very end. So we have talked about fixed income, we have talked about equities. I want us now to talk about pooled funds. Pooled funds, the way they are structured is such that I have my 100 shillings, you have your 100,000 shillings. The fund manager brings us all together and then invest in a particular investment. The reason why this is important is so that we can actually benefit from economies of scale, and also we can be able to benefit from the expertise of these fund managers. So there are different types of pooled funds. We have mutual funds, and this is where the money market fund would fall. We have the exchange traded funds. I think so far we only have one, I think, in the market, which is the gold. Then we have closed funds. Closed-ended funds is that I have bought into this, but I can only sell my units. I will not be able to get in and out. So the mutual funds, I will get in and out as I need. That is what like the money market fund would be. But something like a real estate investment trust, it will be a closed-ended fund. So we will be buying units that the fund is already closed in. And then we have pension funds, which again is another whole conversation that we might not be able to go in through today. It's regulated by the Retirement Benefits Authority, and it works in a very definite way, where you have individuals getting into a fund and contributing to it, or an institution getting in and its members actually contributing to it. So those are different conversations that we can have at a different day. So one of the questions that is always coming when it comes to pooled funds is about security of your investing. So what I thought to do is to actually demystify how the structure is set up. So the structure of the unit trust, they're actually regulated by the Capital Markets Authority, and there are different players that comes in. So you have the investors. So you have the investors who now get into the fund. The fund is registered and approved by the Capital Markets Authority. For the fund to operate, you have different people coming in or providing different services. We have the portfolio manager. We have the custodian who holds the funds on behalf of the investors. Then you have the trustees who oversees the investment to say, is this in line of what is supposed to be done? So the trustee comes and is the person who is overseeing. So remember, you have 100,000 investors. With these 100,000 investors, they all can't voice their their views. So the trustee stands in for them. So once you put your money in the fund manager, with the fund manager or the unit trust, the governance structure helps in terms of reviewing the costs. So what happens? There are daily interactions with the clients and keeps holders registered. That is the portfolio manager. They can actually be the administrators. So that's why when you maybe log into one of the unit trusts, you actually be able to see you have invested 100,000. They are providing the administration services. Then they also decide where the money is to be invested. So not all the time that the portfolio manager is the administrator. There are occasional situations whereby the fund manager is different. They just come in to invest. Then the custodian provides the safety of the assets, and I'm sure Mohammed will take us through custody, and then the trustee really oversees this. With this kind of structure, it is very difficult for all these service providers to collude to actually do the wrong thing. So that the reason for this structure is so that the risk levels for the investors are actually, the risk is reduced by the different parties that are playing there. So there are very many players in the market. How do I select who to go to? One is a performance ranking. It is good to understand this I want to invest and I want my money to work for me. So if that is the case, how are these fund managers working? What are the kind of returns that they are giving? So that is very important, and you'll always be able to get that. Then you need to make sure that this particular fund manager or product is actually giving me consistency in my returns. Then the other key thing is looking at the people who are running it, a relevant experience, just so that you can understand the past records and how that is. The risk exposure, how do we determine risk exposure? Every end of month, if you're invested in this fund with these fund managers, they will send you what is called a fact sheet. The fact sheet will show you this is how we are invested. So you can be able to ask yourself, these underlying assets, do I believe them? Am I okay? Are they well diversified? All those questions come in. So in terms of risk exposure comes in that way. There is also one other thing that I would like to add, technology, because right now we are reliant on technology. So the question is, how can I continue getting my returns and be able to access my money, because liquidity is important. And then the other key question is about volatility. You want consistency in your investment. So I just wanted to show you some of the returns that are there as at yesterday. This is just the money market fund. So the structure will be the same, but in terms of a money market fund, we have, I think, I can't exactly remember the exact number of totally registered fund management companies right now, but these are some of the ones that are there. I'm sure most of us have heard of ZD that has just been launched by Safaricom. Actually has grown pretty much. So instead of your money staying in your M-Pesa, you can move it to ZD and you start earning a return. These returns are actually annualized. They're actually annualized. Thank you, Noel. There are 32 registered money market funds at the moment. So these are some of the players. We have Gulf African all the way to Equity Money Market Fund. So again, depending on what you're looking for, the brand that you care for, you can actually be able to invest in them. So we have gone through, I would say, 2 asset classes and then 1 pooled asset class, because the underlying will be those particular 2. So factors contributing to financial well-being, remember we said it's about savings discipline. It is about having a diversified portfolio. It's about having high returns. It is about making sure that at least the management of what you're doing is low in terms of your affordability, how much you're paying. And also the other question is in terms of your time. Then you need to look at, again, the minimum investment amount when it comes to investing, and then what are the tax benefits. If for pooled funds, if you invest in a money market fund, remember you'll be taxed on the interest. I think it's at about 15%. The fund itself is not taxable, but the money that comes to you is taxable. And then the beauty about pooled funds compared to some of the others is the high liquidity. You can actually be able to get in and out in a very fast manner. Great. So before we conclude this, I would like us to quickly go through some of the investment pitfalls and the possible solution. One is the financial goals. So we need to make sure that at least some of the pitfalls is that we are investing for the wrong goal. What do I mean by that? I want to invest in real estate, but that is my kids' education. What happens if I'm not able to liquidate? Does it mean that my kid will not go to school? Or number 2, I have an investment portfolio, but largely in real estate. Sorry, I'm just going back to real estate because that's where most of us are invested. What happens when you get sick? You are approaching 60, but you are largely invested in less liquid assets. So let's make sure that our financial goals are being matched. The other key question is about diversification. We need to make sure that we are diversifying so that if something goes wrong on the other, at least your life does not completely change. Then the other thing is about investing in things that we do not understand. Let's ask the questions. Let's do the research, because that is important. Then the other issue is about scams. One of the key issue is that we listen to people. Maybe example is when you're starting a business. This business is going to give us a lot of money, and this is how I've made money. I keep giving my Quell example. Let's make sure that we do the work, because if it was that easy, that person would not have easily come and told you that this is how it's going to work. So we need to make sure that we are completely aware of these investment issues. And then once we are aware of them, then we are able to know, how do I progress from where I am? So a quick question, which of these mistakes have you seen someone around you make, or maybe yourself? Yeah, I want us to just look at ourselves and say in the mirror and say, what are some of these mistakes that I see myself in? I invested, I thought I'm going to get in and out, but I was not able to get in and out because I did not understand the risk. Then what steps will you take to avoid them moving forward? Yeah. So it is always good to investing in products that one does not understand. Yes, pyramid schemes. Thank you so much. Investing in things that you do not understand is I think that is for me is the biggest problem that we have. We invest in things that we do not understand. We don't do due diligence, so we end up losing money in the process. So let's just make sure that going forward, we are asking ourselves, flip over things. You see the same thing that we said about when you're doing budgeting. Ask questions. Let someone help you actually make the right decision. And I just look at some of these steps to avoid investment mistake. One of them, please, let's set our goals clearly. let it be one of the goals that we do at the beginning of the year. Let's educate ourselves, because we can, once we understand what is going on, we'll be able to actually ask the right question. The other key thing, read the fine print. Most of us really do not read the fine print, because someone is actually selling something. We just want to jump into it. The other thing is that we don't diversify our portfolios. We jump all in, our heart and everything. Then make sure that you've verified legitimacy. That is a question of asking questions and just looking at how, the professionals that are offering that. Then the other thing that most of us, again, don't like doing is paying consultants. So it is always maybe that 5,000, maybe that 10,000, maybe that 1,500 attending a conference or something would save you a lot. So consult a professional and then always make track progress, so that if there is something that is not happening or not going right, then you'll be able to catch it on time. So those are some of the things that I would like us to think about when it comes to investing. But now I have talked about all those things. And one of the other things that I have talked about is I've talked about equities and fixed income. I've also talked about pooled funds. But now I want us now to decide in two ways. I can actually invest directly, equities. I can go directly and buy Safaricom, DTB, Coop Bank, all those. Or I can actually decide that I'm buying into an equity fund. That is indirect investing. So how do I determine which way to go? I can, for direct investing, remember, I have more control over my assets. I have the fees are potentially low. And then remember, I require a lot of knowledge and time. If you, for example, you're a full-time employed, or you are running your business full-time, at times it might not make sense for you to be able to track this investment on a day-to-day basis. So ask yourself, how much time do you have? Then for direct investing, which is now through the pooled funds, you can actually, they require less time commitment, easy to get to benefit from diversification, and then they're professionally managed. So for you as an investor, decide which is the right way to go. For me, when you're starting out, depending on how sophisticated you are and how much time you have, you can actually start with indirect investing, learn as you go, and then you can actually jump into the direct investing. If, for example, you have time and you can be able to go through the direct investing, then you can. But as you're starting out, please, my recommendation is always to start from the indirect investing. So I want to pause there. I know it has been a lecture that I've moved very fast. Mantui, back to you.
All right, thank you. Thank you, Elizabeth. I think we can maybe answer a few questions before now we proceed on break. So maybe I'll just read a few of them for you, and then we go on break. So we have one from George. He says, "Hey, I'm George. I have been investing 3,000 monthly in a 20-year plan for my children with an insurance firm since 2018. Last year, I learned about MMFs and the power of compounding. With my current insurance, the interest rate is around 6%. Per annum simple interest. Is this a sound investment, or should I withdraw my money and place my deposited money, maybe a fixed deposit fund with a return of 12% compound interest, bearing in mind I might lose all my accumulated interest?" Yeah.
George, insurance is not an investment, it's a risk mitigation measure. So what you are basically doing is still okay, because if anything happens to you, your kids have a fallback plan, assuming it's a true investment. It has those benefits. So again, reading the fine prints to make sure that at least you can get your money back. But I always say even a 6% return from insurance is pretty decent, because you're actually getting insurance from it. So my recommendation is, that is not investment. Get an extra 3,000 and start another investment. That would be my recommendation, because this is important. Because what happens if you're not there? Your kids at least will continue going to school. But investments might not necessarily, insurance might not necessarily be an investment platform. That is very important for us to know.
Great, thank you, Elizabeth. And then Eric asks, what platform does BTB provide for today's topic on investments? And is there any app? So Eric, we don't have a platform, but we do have a custodial business unit. And actually after the break, we'll have our head of custody, Mahmoud, taking us through what this looks like, and he'll also share more insights on investment. So stay tuned for that. Then can have one more, like maybe two. We have an anonymous attendee who's saying, how secure are government securities at the moment with the government issues? Can they be secure? And then I'll just join that with Eunice's question, who is saying, my question is so the treasury bills are the same risk as at the same risk investment with the market. Yeah, so I think maybe just clarification on T-bills versus now when you go through, other funds. Yeah, I think we can answer those two and then go on break. Yeah.
So the true answer is, by the time the government is defaulting, the economy itself is completely in shambles. So the government is still the most secure investment option that you will have in any country. So are they secure? The answer is yes. In terms of treasury bills returns, whatever you have locked your returns in, you are going to get it. The issue is on maturity, you'll be forced maybe to invest at a lower rate. But right now, I think the rates have stabilized at the current levels. So you need to know that you'll always have reinvestment risk for the cash flow that is coming in. So that would be on that.
Great. Yeah, so I think we can proceed on break. We'll just go for a 5-minute break. And I'll encourage participants to share their questions on the Q&A tab so that we can track them. Let's meet back here at 12 and we'll be joined by Mahmoud. Then we'll now have a conclusion at the end by both Elizabeth and Mahmoud. Right, so thank you, ladies and gentlemen, and see you at 12. All right. Welcome back, ladies and gentlemen. So we've just finished part one of the training on investments, and thank you as always for your engagement. And we do hope that you've taken note of the different ways you can begin or continue your investment journey. So now we go into part two, and we will be having our head of custodial business, who is Mahmoud. And Mahmoud currently works as the head of custodial business at Diamond Trust Bank Kenya. He is a member of the Kenya Association of Stockbrokers, ISIFA, and a fellow of the Association of Chartered Certified Accountants. He has a proven track record in the Kenyan financial markets, spanning well over 2 decades. He also has a wealth of experience as a Master of Business Administration educated executive management professional. With over 20 years in the corporate world, he has achieved remarkable success, leaving a lasting impact in sectors such as investment banking, stockbroking, wealth management, and corporate relations. He's a professional and a visionary leader with an interest in giving back to the community. And so thank you so much, Mahmoud, for being able to join us today, and karibu sana. I think you're on mute, Mahmoud. And even as he unmutes, just let us know again what you're looking forward to, and any takeaways from part one, and we continue receiving questions on the Q&A tab. Thank you.
Thank you very much, Mantui. Good afternoon, everyone. It's a pleasure to be your host here today. I think so. Thank you, Elizabeth, for the initial session that you have taken us through. I think so. Everybody is now warm enough for the second session. Mantui, just confirm if you can see my presentation.
I can, but I think it's zoomed in. So maybe you can just zoom it out a little bit. And also, participants, you can let us know on the chat. Yeah.
So we can see it.
You can see it.
We can see, but it's not on
presentation. Okay. Okay.
Is it okay?
Elizabeth, you can help me just confirm.
Yes, it is fine.
Okay, great. Thank you.
Okay. Thank you very much. So I'll take you through the presentation on investment training, and I'll just touch base on how to start investing and how to grow your wealth. And I will finalize with how DTB Custody can help you with your journey to investments. Just a quick snip out. It's not surprising that the world of investment can seem complex, as we have seen with investors today facing often changing market conditions, endless supply of market news, and many investment choices. From the previous slide, we have seen Elizabeth just take us through money markets, treasury bills, treasury bonds. We have zero coupon bonds. We have other SACCO funds. We have digital currency, all this. So there are many investment choices, and it gives a bit of a task to the investor when he's trying to see of what to invest in and how to invest in. So what guidelines can investors follow to achieve better results over time? I have summarized them into the 4 steps. What investors need to do is 1, invest early. 2 is invest regularly. 3 is invest or save the maximum you can do. And then 4 is always to diversify your investment to achieve a better return. So I'll just take you through the 4 subtopics. So investment early, as an individual or as an investor, the first-time investor, it's always wise to invest early in building wealth. Investing early also gives you time that is widely considered as the most effective due to the power of compounding. So according to Bankright's 2024 financial survey, 22% of people say the biggest regret was not saving for retirement early enough. So we can see from there that if you start early enough, by the time you are reaching your retirement age, you don't have to worry about working. You can semi-retire early and have your investments work for you. So compounding is the snowball effect that occurs when funds or savings you have invested generate even more in earnings. So simply put, it's interest on interest. As you gather the interest and you put it back, the interest you get on that additional interest is compounding. So the longer you invested, the more time there is for your investment return to compound. The second one is invest regularly. Investing regularly is as important as starting early. This way, investing remains a priority rather than a contribution deadline. So you don't have to, say, oh, I have a deadline, I need to save something. So if you have invested early and you keep on investing on a regular basis, I think so, as we saw on the charts, the people who have invested 3,000 shillings or 5,000 shillings on a monthly basis in an MMF. So having a disciplined approach can help you build more wealth over time. So if you look at it in terms of the compounding effect, in terms of investing regularly, you'll see over a period of 10 years, if you will have immense wealth that you've built. I know of an example of one of the clients I had introduced to treasury bills back in 2008. He called me, just last year, and was talking to me, and he was like, oh, he started with 50,000 shillings in the treasury bill and used to compound it on a 3-month or a 6-month or a 1-year T-bill. And as of 2022 or 2023, he had accumulated over 10 million shillings in treasury bills. So that's what compounding can do, and investment early and investing regularly can do for investing. So when you invest early, you can also ease into the type of investment or market by not getting the shocks that people get when they invest one time. So when you're, let's say, investing when the markets are low, on a regular basis, the investment units you can buy, for example, if you're investing in Safaricom, when the price is at 13 shillings or 14 shillings, for 100,000 you may get nearly 10,000 units. Now when it goes to 20 shillings where it is currently, you'll be getting around 5,000 units, but you're on an average, you'll be maintaining your price on an average cost of your investment over longer term. So in terms of longer term investments, you'll enjoy that reduced average cost of your investment. So that also is the effect of investing regularly rather than investing in a phased approach. So here, when you do investments regularly, you can average your costs also. Then achieving your long-term financial goal will also begin with saving the maximum. So I like to reiterate the 50-30-20 rule of the budgeting guideline that suggests that after tax income you can look at 50% for needs, 30% for wants, and 20% for savings. So if you can save more, the better for you. That's how measure goals or objectives that you are looking to save, like either retirement or buying a house, or other paying for school fees for your kids in or university fees. It requires significant thought and decision making. So it is vital for you to know how much you want to save for the future, so you can maximize on your saving today, and then the less you will need to save in the in the future when you need that money, or work, 2-3 jobs to meet your ends. And then with that now comes diversifying the portfolio. So when it comes to investing, one of the easiest ways to manage the risk is to just have a variety of investments. So we have asset classes like bonds, treasury bills, fixed deposits, MMFs, real estate, foreign exchange, etc. I think so. This is what has already been discussed by Elizabeth, so I'll not really go into that in depth. So when you're diversified, you're in a bit better position to tap into opportunities across different investments as they emerge. This tends to create a smoother investment. And also with diversification, you also, placed well because you have short-term investment, medium-term investments, and then long-term investments. So any other opportunities that can come in, you can always, close or, conclude on one of the investments and, take a position on the other investment. So if you're looking at it, in conclusion, the successful investment requires a combination of diversification, risk management, and long-term thinking. And by following the above guidelines, one can build an investment portfolio that will help achieve the financial freedom or financial health and protection over time. Any particular questions up to there, or should I continue?
I think you can continue, and then now at the end we can now address the questions.
Okay. So how to start investing and growing your wealth. So I'll also pretty much in summary take you through that. The first tip is to define your financial goals. What are you doing? Are you saving for retirement? You want to buy a house, paying for school fees? This sets the tone for you to plan and achieve your goals. And building wealth is exceptionally immense task and takes time and effort. And some people fall into the Ponzi schemes of getting rich quickly, and this can deter one from investing and growing one's wealth in future. As we've seen from the question that Elizabeth had put up, we saw a lot of guys getting into the Ponzi schemes, which has deterred them from investment. So investment is a process that takes time. And for me, two things are very crucial when I advise my clients. You have to look at two things that we have to consider is you have to be patient and you don't have to be greedy. So, don't expect, high returns significantly year on year. With high returns, there is also high risks. So as people say, Rome wasn't built in a day. Same applies to wealth. It will take time to build your wealth, and you have to just ensure that you are at it regularly and you invest and diversify. So before one starts investing, what he or she has to look at is do they have enough for basic needs, and do they have a surplus for saving? Maximize your saving by managing the spending, and diversify the investment so that not all eggs are in one basket. In terms of investment strategy, one needs to design that for both for short-term and long-term investments. This strategy is not a one size fit all, but it greatly varies from person to person. Some of the factors that include are age, your lifestyle, your capital available, expected return, risk appetite, and financial situation. This is not an exhaustive list, but they are factors that can be broadly determined. The strategy one will design. So for adoption of strategy, it's good to engage with a financial advisor. You'll pay that extra few shillings, but at the end, the value for money that you will get on the advisory will take you in a long way, and also will give you a position, that you can always, fall back on to get some assistance in case one or two investments go south. I'll just talk about two broadly, largely classified investment strategies that we have. I'm sure Elizabeth has touched on this in the previous sessions. So we have the conservative investment strategy. This is more suitable to shorter time horizons where people look to preserve capital, are low risk and have a stable return. So this is more if you're looking at it, that if you're comparing a 20-year-old to a 40-year-old, a 40-year-old will be more on a conservative investment strategy because he doesn't have now that edge. He is on that edge limit that he can't really work or put more effort, he must have a family, he'll have other priorities leading to it. So he'll have a tendency to preserve his capital and will look at low risk return investments so that, he keeps up his financial health. On the other side, we have the aggressive investment strategy. This is more suitable to individuals with a longer term horizons. As I said, a 20-year-old or a 25-year-old, what you call these days, I think so, Gen Zs will be looking to, take some more high risk investments. They don't mind losing some of their capital, as they can always come back and work on getting back their capital. So here they're looking at maximizing on the return. So these are two broadly, largely, investment strategies that are there in the market. So currently, opportunities, well, I think so Elizabeth has also touched on this. I'll just take you through some of the investments that are the opportunities we have currently. So investments in listed shares at NSE are medium to long term. Most of the shares are like on a 12-month to all-time low, giving an opportunity to invest and get a good return dividend and dividend income of between 8 to 12 or 8 to 13% on some of these counters. And then you're also having some good capital gains. As we've seen also, some international firms are also quite aggressive in the stock market. So that gives us also a sense of comfort that, there are foreigners who are also looking at Kenya as a investment hub. We also have the investments in treasury bills, as Elizabeth has discussed. These are more, T-bills are more short-term, bonds are more longer-term, and it gives you T-bonds more gives a fixed income for a fixed period. This can assist you in paying your fixed costs like house, rent, bills, etc. So if you have an investment opportunity and you want to, have a fixed income every 6 months, you get a coupon. Interest comes in every 6 months. So, you can manage your fixed costs on that side. And then investments in fixed deposits. These are short-term investments, relatively liquid and stable. And then obviously the mutual or money market funds. These are short to medium term. Great starting point for those who are looking to start investing. So you can, dip your foot into the water by having the money market fund. So going into money market fund gives you a bit more leverage, understanding, easy to come in, come out, the use of technology or digital space. So it's easy for you to, understand the investments. I'll also take you through what we do at DTB. So on the custodial business, we are licensed and authorized depository or a custodian by the capital markets. We also are a central depository agent through CDSC, and we are also registered and licensed by the Retirement Benefits Authority. So this, we can also handle, pension funds. We can invest into equities, shares, we can also handle the bonds and bills on behalf of the clients. So what are custody services? These are just generally banking services that are linked directly and revolve around the safekeeping of investments for capital and money market instruments such as fixed deposits, treasury bills, treasury bonds, corporate bonds, commercial papers, equities, foreign investments, etc. So that's what custody services are. What do we do? We currently offer safekeeping of investments and documents. So no, we are not a safe deposit box, but what we do is we, as a custodian, we safeguard the investments on behalf of clients. So, because the custodian is linked to the bank, it's a much safer way to go to the market. So we do investments, or we also do the central depository services, facilitation and maintenance of the depository accounts with CDSC and central bank. So if you want to open a CBK account, you don't want to go directly to CBK, we facilitate that. We also facilitate the CDSC or share account opening form, account documents. So you can open an account through us and maintain that account at one stop. So here we also do settlement services, so settlement in trades in equities, government paper, corporate debt on behalf of clients. We also do corporate action processing that includes now we collect interest, dividends. If there are any rights issue or bonus issues, we collect it on your behalf with the registrar. We follow up on the maturity payments, and we also then give you, a notification of what you can invest in or what are the opportunities available in the market. And then we also do cash and asset reporting, both to customers and regulatory. This also helps the client because you have one-stop shop for your assets held into treasury bills, treasury bonds, shares, corporate paper, foreign instruments and stuff. It gives the client the ability to monitor and manage the portfolio easily. You have a statement at the end of the month. It gives you a position of where your investments are and how your investments are doing. And we also represent the customers at AGMs with the consent. So we also, this is more or so for the asset managers or the, wealth managers who want us to represent them at the AGMs. So generally, currently, we, as DTB custody, we currently offer treasury bills, treasury bonds, and shares as the products, but we're also venturing into different money market funds, and also we will be also going into the foreign investments such as Eurobonds. So you can invest into USD denominated funds within a short period of time. So in conclusion, what we can do is provide numerous benefits for investors looking to manage their assets in a safe and efficient manner. We also facilitate end-to-end processes, opening the accounts on behalf of the clients. And this allows you to trade into different securities quickly and efficiently. And with one-stop shop, we have as custody, we have various panel of brokers that we deal with. So we are not stuck to one particular broker. We also engage with the client one-on-one to inform them about the investment opportunities in the market. The client also receives various market reports on a regular basis and ensures that the client makes the informed decisions on this. Yeah. So thank you very much. I think so that's it from my end. Mantui.
Thank you so much, Mahmoud, for breaking down, some of these complex concepts into very simple and understandable concepts. I see in the chat some people are actually surprised that DTB carries out all these, has all these services. So yes, at least today you've gotten to understand more of what we do. and opportunities that are present for you. So thank you so much, Mahmoud and Elizabeth. I think now we can answer a few questions that I'll alternatively address to you and Elizabeth, and then we will have now the closing remarks at the end. So thank you so much. All right, so I have seen quite a number of questions around the T-bills and the T-bonds. And, when you have a certain amount, so allow me to just group a few of them, and then we can begin with Mahmoud. So David asks, where would you advise someone with a sum of 200,000 to invest in MMF or T-bills? And then Eric has a similar question where he asks, if I have, for example, 300,000 right now for investments, practically where do I start, considering what the current market entails with the diversification mindset as a starter pack? Yeah, I think we can start with those ones, but I'll bring up more questions on T-bills later. So Mahmoud, thank you.
Okay, thank you very much, Mantui. So I think so on the position of where to invest the 200,000 and 300,000 in choice of MMFs and T-bills. So I think so one has to define what is the timeline in terms of what are the investment periods. Are they looking at, minimum periods of 6 months, 1 year, 2 years? If you have a longer term period, you can compare the rates between the MMFs and the T-bills. On an average, I think so right now, T-bills will give you slightly more better rates, but I think so to split that is always better. So I think so 100,000 each on either in the T-bills and the MMFs. So that it gives you a bit of diversification, and also it gives you a starting point into the investment world, and you get to also understand how T-bills work, and also get to know how the money markets work. So yeah, that's a good starting point. So you can take from there and then build on it from there. Yes, Mantui, any other questions?
Thank you, Mahmoud. Sorry, I was muted. So let me go now to Eric, who asks, what red flags should I watch for when picking a broker or investment scheme? I think I'll address this to Elizabeth. And then, a similar question to what was asked, how should I split my investment between T-bills, bonds, MMFs, and stocks based on my age and risk appetite?
So thank you, Mantui. I think the starting point is just for you to look at the starting point is regulation. So you need to make sure that whoever you're dealing with is regulated, and look at the track record of the people running the organization. And I think those are the two key issues. And just looking at the past performance, especially when you're thinking about the money market funds or the pooled funds. So those are some of the things that you need to look out for. So I think the beauty about the brokerage, they are not touching your money. Most of the time you're buying and selling at the same time. So the risk is really low when you're buying through any broker. So level of automation would be it, and whether you are getting your statements on time. When it comes to how do I split, again, I go back to what Mahmoud has said. It's really giving a wholesale answer on private management matters becomes very difficult, because what are your goals? How much cash flow is coming in? All those things come into place, and that is why sitting down with a private wealth manager would help you craft a way forward on that.
Great, thank you, Elizabeth. I also see a number of hands that are up, so I'll allow a few people to raise their hands even as we continue addressing the questions on the Q&A tab. So Elizabeth, Ephraim, John, and Rona. So one of you can go. Just enabled you to ask your question. Elizabeth, Ephraim, John, Rona. All right, even as we wait for them, We have George asking, today there are MMFs that are offered in dollars. How secure are they? And are they still regulated by the authorities here in Kenya or others? I'll address this to Mahmoud because there was also a question around if BTB supports investments in, foreign investments and offshore sort of accounts. So yes.
So just to give background, I think so. Currently, DTB doesn't have a direct MMF that it offers, but we are in the process of hopefully getting that on the DTB channels in the coming future. So we currently, as DTB, do not offer any MMFs, but there are list of MMFs that Elizabeth has, I think so, shared. We can share that with you, and then you can look at it. In terms of the MMFs in USD, yes, all regulated any MMFs that are in the market currently, whether it's in Kenya shillings or USD, both are regulated by capital markets. And in terms of how safe they are to invest, basically they hold the same as long as the institute is regulated. It's regulated by capital markets. The security of that is it's a licensed entity and doing that, and any MMF that it comes to the market has to be passed through the capital market. So capital market has to issue a letter of no objection for it to come through. So in terms of safety in USD MMFs, they are as safe as they can get. But at the end, the risk is always there. And, we cannot write off that risk as a party. So the risk always will be there, but I think so currently they are much lower than because they're all regulated entities. And I think so Elizabeth can add a point or two on that side. Just to also answer another question that was said, how early is early for investments? I think so. I will say that you need to start. If you've not started, then start today. You need to make sure that you have the budgeting guideline which I presented. So try and maximize on the investments you can do. Even if it's 1,000 shillings a month, you try and save that and keep that for a rainy day in the future, and have a long-term view rather than a short-term horizon. That helps you to, it helps in compounding and, growing your wealth.
Thank you, Mahmoud. And I think this is also just echoing the conclusion we had last week on the budgeting session, that the critical time to start is now. And so I think the aim of all these sessions is that you're able to take action and, get well on your way to financial freedom. So there's a few questions on commercial papers that I would like to combine, and I think Elizabeth, you can help us answer that. But first, there's one around the difference between direct and indirect investments. So we have Brenda just seeking clarity on that. And then we can also now speak about, let me just combine Duncan, Habiba's, and Stephen's question. So the first one is, what is a commercial paper and how can one invest in it? And same for equities and trust fund. And then Habiba asks, explain further on corporate papers and are there any offers? Stephen still asks, how does one invest in commercial papers or corporate bonds? Yeah, so those three around the same theme. Thank you, Elizabeth.
Thank you. So commercial paper, sorry, let me take a step back. How do you fund a business? You fund a business through equities or through loans. So how do people make, how do then businesses get loans? They can go directly to a bank, or they can get that structured outside. So commercial papers are lending to businesses, but not through the banking arrangement. So it is through a structured solution. There are some there's some brokers or investment banks that really are known when it comes to organizing commercial papers. One of them that comes to my mind is Dry Associates. They have a couple of corporate papers. So if you wanted to get into that market, I would be happy to connect you with someone there. So there are a couple of them, and some of them are approved by the Capital Markets Authority. Some of them are not approved by the Capital Markets Authority. So when you're getting into commercial paper, conversation, corporate bonds, all this you're lending to institutions, you need to make sure that you're asking the hard questions, you understand the risk that you're undertaking. So that is what I would say about that in terms of the commercial papers, Mantui. I think that covers it broadly.
Yes, thank you. And then now the question on direct and indirect investments.
So for direct investments is where you are able, you want to do the security selection. So I want to buy Safaricom, I want to buy DTB, I want to buy KCB. So I'll call the broker and tell them, this is what I want to buy. That is direct investment. I'm doing the security selection. I want treasury bill directly. The indirect investment is now where you're putting your 100,000 into a pooled fund, and then the fund manager does the investments for you. So that is what is indirect.
Thank you, Elizabeth. So I'll go back once again to those who've raised their hands. If I've seen Rona, you've been, if you're able to unmute Elizabeth, John, Rona, Duncan, you can have a go. I can see Duncan has unmuted, yes. Or Rona, please do go ahead. I have also allowed Peter and Suhaib. All right, I think, okay, we'll just come back to check once more. We can continue with the questions. Okay, there we go. Yes, Duncan.
Thank you so much for the kind job you are doing to us, DTB and Zuri. Now, my interest on the government bonds and treasury bills. If I may ask, what is the minimum and maximum you can invest in treasury bonds? And does it work on does it work on both short term and long term? Then I'm working on a project of starting a consulting firm in tax. What advice, Elizabeth, can you give as I begin? Because I'm in the initial stages of beginning. Thank you.
Okay. Mantu, do we take a couple before we respond, or we respond on?
Okay, that's all right. We can have Rona trying, Peter or Elizabeth. Rona, I can see you've unmuted. You can go ahead. All right, I think, Elizabeth, we can respond to Duncan's question and then proceed from there.
In terms of minimum investments for treasury bills, it's 100,000. For treasury bonds, it's 50,000, and in multiples of 50,000 for both. So those are the minimum investments. And then in terms of tenor, the treasury bills, it's clear. It's a 91-day, 182-day, or 364-day investment. So you select that up front, and you have to wait for maturity. For bonds, again, if you're coming to the primary, I think like the one that is on offer to now, I don't know if it's a 10-year bond or a 20-year bond, something like that. So you select and wait for, and that's what you bid for. If you want a tenor in between, if it's not being offered directly, what is called a primary offer, the primary market, then you can be able to go to the secondary market and purchase it. This is through any of the brokers. So you can actually play with the tenors as you wish. Then in terms of tax consulting, what should you be aware of? I don't know whether it's in terms of business, what should you be starting to think about? Is that the question?
Yes.
Okay. So I want to summarize it in the things that you'll need to think about. What is your unique proposition? So what is your product? So it will be good to do the business canvas for your business. You need to understand how do you market, how do you get clients on board. then you need to think about what are the processes that you're going to place, the product that you're going to put in place. So as I've talked about the product, I've talked about the processes, then you needed to think about the marketing and the people that you're going to collaborate with. So if you think about all that, you would be able to start it off well. You can get a copy of my book, Thrive. I didn't want to market, but it has covered when you're starting out. I have a book that I've Transcend. It's all about starting a business and the key things that you need to do to scale. So you can get a copy of that and you can have a chat with me. Thank you.
Okay, thank you so much.
Thank you, Duncan. Then the next couple of questions I'll address to Mahmoud. We have questions around the cost of the services that are offered by DTB. And then we have Isaac asking, as an individual client trading directly at NSC, how can I benefit from these services? And then Byron Ucheng asking, can I open a CDS account at DTB or UGIS branch? Yeah, thank you.
Okay, thank you very much for those questions. I think so, yeah. In terms of cost of services offered by DTB, we have tiered fees that we charge on custody. So if you're doing anything on treasury bonds, we have a tiered approach. So anything below 100 million, we normally have annual fee that we charge of 0.5% exclusive of taxes. That's the maximum we charge. It depends on the amount. And then anything above 100 to 500, we normally charge around 0.35%. Again, exclusive of taxes. And anything above 500 million, we normally have an annual fee of 0.25% exclusive of taxes. And this fee is prorated on a monthly basis. So it's not charged upfront or at the end of the time. It's charged on a monthly basis based on the portfolio amount that the individual or the client holds. So that's the fees on treasury bonds. On treasury bills, we have, and on treasury bonds, I think so when you're buying from the secondary market, there's the brokerage charges that are applicable. It rounds up to 0.035% on the trade value, on the consideration. On the treasury bills, we have a flat fee of 0.25% exclusive of the excise duty. So it inclusive of excise duty currently comes to 0.3% per basically prorated again depending on the T-bill you're applying. So for example, if you're doing an application of 10 million for a treasury bill, 0.3% is 30,000. So that is per annum. If you're doing a 6-month T-bill, that is a 182-day T-bill, then we will then charge you half of that. So that will be 15,000. And then if it's a 91-day T-bill, so it'll be 30,000 divided by 4, that is per quarter. So it'll be 7,500. So it's per application and prorated on the tenor of the T-bill. Okay, so that's on T-bill with our minimum fees being 3,000 shillings. So for example, if you're doing 1 million, whether you do 90-day, 180-day or 1-year T-bill, it'll be the same 3,000 because 1 million at 0.3 per annum is 3,000. So our minimum fees on T-bills are 3,000 shillings. And then on shares, we don't have an annual fee. What we do is on shares, we just have transactional charges that we charge, and the brokerage charges will apply based on the negotiation with the broker. So that is on the fees. If you're an individual trading at NSC, what we can do, if you want to open a CDS account with us, we can always facilitate that. We can open that. You can engage with us. The advantage is we will have, we have more market players that are showing us offers and bids. So, we have a panel of brokers that we deal with. We are not stuck to a particular broker that we need to deal with. So we have 6 or 7 panel brokers on our panel, and it gives you a bit more market color if you're trading regularly, and we can try and get you some competitive investments. And the other thing is you can also hold a CBK account with us. So if you want to invest in T-bills and T-bonds, you can also do that through the same account. So you don't have to worry about, opening different accounts with different brokers and different entities. And yes, if you want to, on the question of if you want to open an account through Oyugis branch, you can open that. You can visit them. They can connect you with us. We can liaise with you. We can share you the necessary documents to onboard you as a client on the custody side and open the account for you. So yeah, thank you very much.
Thank you, Mahmoud. So we also have another question just around that is, does BTB have a tailor-made personal consultant advisory cost? And I think also there's a question that has come to Elizabeth around costings as well. So Mahmoud can go and then Elizabeth. Thank you.
Okay, I think so. The question from Lillian in terms of advisory cost, we as a custodian are licensed not to do any advisory. We're not a fund manager or an asset manager. So it's not within our mandate to do advisory. What we do is give you options as a client. We don't have any fees that we charge. So we have just generally, we give you what are the options available in the market. If it's T-bonds, various T-bonds available, T-bills, what are the T-bills, what are the rates, and even shares. And then it's up to the client to do that decision making. So we don't do any decision making on behalf of the client. Thank you.
So Mantui, I think the question that you're asking about fees. I would maybe the way I answer it, let me take a quick view in terms of what Zurich does, and then someone can see where they fall. So we do a couple of things at Zurich. We train like what we are doing today. We train through institutions and we train individuals. So for individuals, they can join various classes that we have. Every Tuesday, we do a free training. That is just for a very specific conversation. Like this, the coming Tuesday, we shall be discussing about stocks. We'll talk about money markets. That's for a whole hour to discuss that and to ask questions. Then we have someone who want a structured and they want to get out with something. There's what we run is called Prosperity Fundamentals. So we do that every month. We are doing an intake every month. And by the end of that time, we will have taken you through your goal setting, your budgeting, your investments, and we shall have a plan. And the addition to that is now what is called Prosperity Fund dashboard. You will have everything to track, and we shall remind you when you need to do that. So for that, we only charge about 15,000. It's a 5 weeks conversation, or we meet every Thursday to discuss, and it's a class and then an individualized session. So that is what we charge on that end. Every month we hold a conversation about investments. Like this Saturday, we shall be holding key investment mistake that people make. It's 1,500. You come there, we discuss and we learn from each other. So you just need to book, and then you come and we discuss that. If someone wants what they just want is like, I want to come up with a 1 hour conversation about money. We just charge 5,000. You just come, we sit, we go through what are your goals, and we document them, and we also put them in the dashboard so that we become your accountability partner. Now, again, for people who are in institutions, they are running MSMEs. They would like us to train for their people. Again, that is a conversation we can have, tailor-made from 2 hours all the way to a whole day. And you can actually join. Is like for retirement training, you are employed, you want to plan about your retirement today. Again, you can join our quarterly conversations, and that we usually do offsite. So in a nutshell, that is what we do. We do advisory. If you're doing your fundraising, again, we could actually be able to do all that for you. So that is what Zurich is about. Please visit our website, and we shall be able to see all these conversations and what we do and the charges that are there. Thank you.
Thank you, Elizabeth and Mahmoud. So I just want us to wind up, and I'll give one more chance to John, Rona, and Peter, if you're able to speak, because your hands are up. Please do unmute and speak. All right. So I think there's been questions around certification, just like we communicated at the beginning. We will be offering digital certificates to participants who completed all the 4 sessions, just to celebrate your commitment and dedication for this month. I think it's a good thing that you have taken the time for, these 4 weeks to choose to make steps towards your financial freedom and financial wellness. And so we will be celebrating that. And if you also remember, we did carry out a baseline survey just to understand at the beginning of these sessions where you lie in terms of your, your personal finances. And we will be reaching out on email with a follow-up survey just to gauge post these sessions, are there any improvements you've had when it comes to your personal finances? So thank you so much for that commitment. I would like to have, closing remarks by Mahmoud and Elizabeth. Just, what are the key things that you'd advise our participants, based on all the modules we've had and as well as today's session. So we've covered, understanding your financial position, pillars of financial security, budgeting, and today we've covered investments. So please just give us your closing remarks, and then you'll have access to all these modules. This is for the participants, and the presentations on our DTB website. And on the website, you can also find previous sessions that we've done before. This is the first one that we have done for personal finances. So the ones you'll find will be for SMEs, but you can always get a module or 2 that would be relevant to you. And so even as Elizabeth and Mahmoud are giving their closing remarks, please do mention on the chat, things that stood out, your initial feedback. We always love receiving that, and it always helps us when it comes to designing this program. So Elizabeth, Mahmoud.
Maybe I can go first. I think, first of all, is to thank DTB. Thank you so much for the opportunity to be part of this conversation. For the people who have been able to sit in, go through all this, I think there's a lot of conversations that we have held over the last 4 weeks. There is a lot of, I think some of them were really, we have moved very fast. But remember, this is just planting the seed. The work has to be you. You have to accept that you need to do the work. We are here to help you make make your life much easier. At Zurich, we are all about making money easy and making life better, because we believe that the more we know, the easier it is for us to make conversations. So feel free to, for the people who are here, please just go to our website, subscribe to our newsletter. We do a lot of newsletter writings about how you can invest, where to start. We will handhold you. Follow us on our socials, because we also write a lot about investments, because we believe that in sharing information, and that is the way that we make a better world. So asanteni sana, and truly appreciated the time. Thank you, Mantui, for guiding us through this. Thank you.
Thank you, Elizabeth. Mahmoud.
Thank you, Mantui. I think so from my side, my advice would be, if you've not invested, start now. If you've invested and your investments did not come through at that particular time, I think so it's just a learning lesson, and you can always reinvest and start slow. You can start small but grow it. Do it on a regular basis. Don't wait for next month to start something and saving big. Keep it small, keep it regular. Do it, and also be patient with your investments, and don't be greedy. Don't look for the highest returns. Look for or position yourself into and research well into what you're looking at into investments. What investments are you looking at? If it's doing through a particular entity, then make sure that they are licensed by either the capital markets or CBK, and make sure that their fundamentals are sound of investments. So that's from my end. Thank you very much.
Thank you, Mahmoud. Keep it simple, keep it regular. Thank you for those closing remarks. I'd also like to share with participants that for those who are interested in doing testimonials, especially if you've been part of these trainings for a number of years, we would love to do video testimonials with you. And I've just shared my email on the chat, mturgo@dtbafrica.com. Please reach out if you're interested in video testimonial so that we can just hear your story and what impact, small or big, these trainings have had on you. So thank you so much, Elizabeth and your team, for being with us throughout the month and the insights that you've shared. Thank you, Mahmoud, for taking the time to break down these concepts and, for sharing what BTB is doing in this space. Thank you, Faith and Lillian, as always, for the great sign language interpretation that you help us with. Thank you to Azmira, who is our head of sustainability and communications, and the entire DTB team that has worked behind the scenes to make this possible. And last but not least is thank you to all the participants for showing up, for being very engaging, and for taking the steps to make your life better than it was a month or so ago. So we'd like to conclude there. We will be in touch and we'll be sharing any sessions trainings that will be coming up. So just always be on the lookout for the emails from DTB for any good things coming your way. So thank you, ladies and gentlemen, and have a great rest of the day.
Thank you.
Thank you. Bye.